Okay, so very good morning to everyone. Hope you had a good evening. To the briefing for Thursday, the 11th of August. Starting off with a couple of news items first from overnight, and then we'll get into some of the charts, price activity from recent days, and then heading in towards today's session. I know I can see here on my charts already cable seeing a bit of downside this morning. Just keep an eye on that while the briefing is ongoing, having broken through that 130 level that was holding up some of the price action from yesterday afternoon. So cable just seeing a bit of downside pressure here at the moment. But in terms of the US close yesterday, did see a pretty interesting statistic. So the S&P 500 closed down 0.35% yesterday. That was actually the third largest decline in the last 10 days, 0.3%. Now that kind of ratifies then the August summer thin trading conditions when you've got 0.3% finish on the exchange for the S&P, and that's one of the biggest moves that we've seen in the last kind of 2 weeks or so. So again, the calendar, we'll get into that shortly, but pretty quiet again. So be looking for a similar type thing, but obviously there is that propensity for market spikes given the thinner liquidity, as Vas was indicating yesterday. So be mindful of that. And if a key technical level does give way, obviously there's less there in the market, probably underneath the key, let's say, support level. If, for instance, say the pound keeps dropping at this point and likely exacerbates some moves. So there are going to be some opportunities. It's just about being patient and waiting for them to come to you more than anything. A quick look at some other things from overnight. Earnings season is pretty much done and dusted at this point. A couple of bigger German names, though, have reported. Deutsche Telekom, an 8.6% increase in second quarter profit. Surging sales in their US mobile phone unit, offsetting weaker performance in Germany. Elsewhere, RWE, second quarter loss narrowed 22%, improved performance in the German utilities power plant business. And ThyssenKrupp, which is Germany's largest steel maker, they reported a fiscal third quarter profit fell 18%, as record steel exports from China continue to put pressure on their prices. So a bit of a mixed bag there. Not really having too much of a read across this morning. So earnings really have taken a bit of a backseat, and overall the earnings season really passing through without any real massive mishaps. The one thing, I guess, from a decreasing profitability point of view for a lot of the banks for sure, particularly in this lower interest rate environment, is that the Fed more likely, another area in which their accommodative policy is probably going to be the most important in order to sustain what has been companies losing money over a number of quarters now, and their projections generally for profits having moved lower. We did also have the Reserve Bank of New Zealand had the interest rate decision overnight, lowered their OCR rate by 25 basis points to a record low of 2%. Their Governor Wheeler stated monetary policy is still to stay accommodative, and that projections indicate that further easing will be required. It seems to be that's the new monetary norm now in terms of communication, pretty much identical then to the language in which Mark Carney was using just last week. The fact that they're at record low interest rates now in New Zealand, much like we are in the UK, and a commitment to go further lower if necessary. So certainly slowing global growth a concern across central banks wherever you are in the world at the moment. First of all, a quick look at oil prices. I've just got a slightly longer dated here to encapsulate where we are at the moment. We had obviously the big wave lower when we moved from $50 all the way down to sub 40 briefly. Before then we started to hear some noises about talks for potential emergency type meetings to discuss output freezes. We've then risen since that point. We've hit around 43.50 type level. The circle here that I've highlighted was the data from last night or yesterday afternoon. That was when we had the oil inventory numbers. So a quick recap on that, because I did have a few questions, because we initially spiked up. Before then, the trend was ultimately lower. The headline reading was a build of 1.055 million, but the initial snap higher was on that figure because the APIs was a build of 2.1 million. So although the build itself was only half that as seen on the prior night's APIs, so therefore prices immediately spiked up. Now, the Cushing number at 1.16 million, the distillate number, a draw of 1.9 million, was all pretty much exactly the same as the APIs. The one that really stood out from a more bearish perspective was the gasoline figure, which was a draw of just 2.8 million, which although on its own would be bullish, the API showed a draw of 3.9 million, so the draw not as big, and therefore prices soon came off. The US output, which has been a focus of late, was largely ignored because the 0.177% change here is relatively benign when compared to some of the percentage swings of output changes we've seen over recent weeks. That, of course, came in the context of OPEC and the biggest nation, Saudi Arabia, saying that yesterday their record output due to seasonal demand for the hot temperatures forthcoming over the summer period in the Saudi area, and therefore with them cranking up their output to record levels, prices have continued to fall this morning. And we're still trading negative territory, so we're down around 42 cents, probably $41, the next line in the sand. That also lining up with that low print printed back on the 5th, but seems to be the new defined range here between the kind of 39 to 43.5, so $41 being mid-range of that. Now, today, in terms of energy news, there are a couple things to look out for. We do have at 9 o'clock, I believe it is the IEA's oil market report. This comes after the OPEC monthly report we had yesterday. So the OPEC monthly report said that weakness in global oil markets, which has dragged prices to a near 3-month low, may persist as demand slows seasonally and fuel inventories remain abundant. There are lingering concerns that the US and European refiners may reduce processing rates as profits fade amid continuing overhang of crude and refined fuels. So i.e. still a large amount of surplus in the market. Gasoline consumption will taper off in the US with the end of summer vacation driving season. So remember, in the US they have what's called, for any oil traders, driving season is the period over summer when families in the US, rather than fly, they drive across states. Obviously we're talking hundreds of miles, and that increases by a high degree the consumption of gasoline. So there is a seasonal aspect there, but obviously this being slightly countered by what the Saudis were saying yesterday. Now this is important because the last IEA report that we had from last month showed quite an interesting perspective from a world oil demand side. Now, although the OPEC monthly report was questioning the likes of demand for those seasonal factors for driving season in the US, ultimately, from the IEA's measure, going into the forecasted periods here for 2016, world oil demand is seen pretty much at its highest level at this present time. So this is going to be something, if you are trading crude at 9 o'clock, just to keep an eye on. Any faltering demand for oil in their report could potentially put some additional downside pressure on these prices, which are already trading slightly on the back foot this morning. The other thing to contemplate is the dollar. It continues to see a bit of strength this morning, so that selling pressure that we had more recently in the US dollar has started to abate slightly, and we are up around 0.2% in the dollar index this morning. So consequently putting also a bit of downside pressure on oil, but also a bit of downside pressure here, top left chart on cable, with euro dollar also seeing an extended move lower this morning on the breakthrough pivot, which was holding up in the late Asian session. Just taking a look at this top left hand chart here at the pound against sterling, or the pound against the dollar. Obviously, this is the big fall that we had post-Brexit. The defined range that we've had then has been around the 135 type levels down to lows just above the 128 mark. But quite key then is when the Bank of England delivered that three-way package, which was much more than the market was expecting, we have obviously had the big intraday move lower. But since that point, and that commitment from Mark Carney that rates can go lower, we have continued to slowly edge down, albeit in a fairly slow fashion given the fact that markets are pretty quiet at the moment. But getting below this 130 level with confirmation of that, I think it's going to be key if we are to see ultimately a test down at 128 at some point in the near future. So I think that 130, if we can close beneath there today, is going to be psychologically important for this continuation of this downward trend. Now, one thing I have read this morning in UK news is about the housing market. So if there are any potential first-time buyers out there, you might be a bit more happy to know that the Royal Institute of Chartered Surveyors, so RICS, they've said the Brexit is undermining the near-term outlook for the UK housing market. Both demand and sales have dropped in July. So the London-based group saying that new buyer inquiries fell for a fourth month, while its index of sales is pointing to the fastest declining transactions since the global financial crisis. You can see here the combination of the Brexit vote, George Osborne's departing gift of an increase in stamp duty, so tax hikes, thanks George, means that UK housing market in July has come under quite severe pressure, and in fact then from their data the worst since the Lehman Brothers crash. The slight silver lining though is that the fact that the Bank of England had cut borrowing costs, we're at record levels, and if we go lower to 0%, then obviously that does help potentially first-time buyers, people tied into mortgage to interest rates trackers. So the actual 12-month price expectation from RICS has risen to 23 in July from 0 in June. So the kind of longer-term prospects, certainly on the premise that the lower interest rate that Mark Carney was very explicit in saying should be passed on to homeowners, is seen as a positive in the next 12 months. So although negative overall in the current state of play, potentially a more brighter spot for the future. One other story of note as well that has caught my eye has been a Chinese story in Xinhua, which is basically the state news agency. They've had a headline story saying that market speculators betting on monetary easing in China will probably be disappointed. The PBOC is unlikely to resort to frequent interest rate and reserve requirement ratio cuts in the second half of this year. Now, that to me is a little bit worrying, because this market has been predominantly propped up. This bottom left chart here that I've marked up, from late June through early July, we saw this monster rally post, this was, let me circle when the Brexit occurred. This was the Brexit sell-off in terms of the ramification on the S&P. Then we had the commitment, essentially via communication and now via the new stimulus measures out of Japan, this big package out of the Bank of England that's now being delivered, the expected further easing to come from the ECB and the BOJ, the big rally here in US equities and global stock futures. That was around a 10% rally that we saw in the S&P after briefly breaching 2,000 post-Brexit to where we are now, around all-time highs. The only thing is now we've gone into this consolidation period, and from a 10% trading range that we had through mid-June to mid-July, we've now been confined to around a less than 2% range. So at this point, again, that 2183.5 is your new kind of upside level that's contained prices, and if anything, you could probably define that by an even tighter range between 83.50 to 68 and 3/4, given the market conditions are very quiet at the moment. Certainly today, barring anything unexpected, should be quiet again. Tomorrow's when the main US data is coming out. But again, the reason why I'm a little bit concerned by that Chinese commentary is that if the central banks start to backtrack from their commitment to provide more monetary easing, does the bubble start to burst in regards to this equity overvaluation, so to speak, of where we trade at the moment? One other final piece as well, looking at the calendar for today. As I've said, things are going to be pretty slow going. You've got that IEA All Market Report shortly. Look out for that. The only real figure of interest is going to be the weekly jobless claims from the US. And I read a very interesting comment out of Deutsche Bank's chief economist this morning, who said that claims have hovered around multi-decade lows for the past 4 months, thus indicating the labour market has reached, or likely reached, full employment. Given the present stage of the business cycle, he advises keeping a very close watch for any potential spike in the claims, given the existing pressure on corporate profit margins. So although we've been fairly consistent, claims have been one of the better strong points of the economy in the US. If we get near full employment and the fact that corporate profits margins are being squeezed, does that result in some layoffs and a spike in claims at some point in the near future? Something just to look out for in today's data. Okay guys, going to wrap it up with that. As I said, keep it tight, keep an eye on these market prices, identify key levels, be careful about moves being overextended or exacerbated by the thinner market conditions, and then enjoy your trading day.